Welcome to the Business of Property podcast. I'm Simon.
And I'm Stuart.
We're both property people running our own businesses. This podcast is just us chatting, as we often do, about anything and everything property. This week, I think, Stuart, you're going to kick us off with a quite remarkable headline that you've seen recently.
Yes, it was about the number of transactions in February, because it kind of staggered me. So I know we're sort of into April now, but obviously the figures are coming out. But the line is that more homes were bought and sold in February than in any February for the last 15 years, which I just found quite staggering when you think about where we've been and where we are.
Exactly. We're in February, particularly, the housing market was working under a fairly strict lockdown. It was still open. There were viewings permitted, but they had to follow pretty strict COVID precautions. And I talked, I don't know, a few weeks ago maybe, I can't remember when it was, about my own COVID viewing experience. And it is very restrictive. It is limiting in what you can do while you're looking at a property. And yet it's not been slowing people down. And presumably, given sort of other pressures around meeting stamp duty, holiday deadlines and things, the market as a whole has just been accelerating. It's incredible.
Yeah, I should point out that this is the transactions data from HMRC, which we're making an assumption is coming from the stamp duty numbers. So in terms of transactions, for me, that just translates into sales, how many actual sales have taken place. And the data is saying that 122,840 transactions took place, which was 48% higher than February 2020 and 23% higher than January 21. So year on year, almost 50% higher, and month on month, or a quarter higher, which is staggering, isn't it? Considering we are in lockdown, or were in lockdown at that stage.
And when you compare back to February 2020, we were not in lockdown at that point. And in fact, while there were some rumblings of pandemic concern, nothing had actually sort of really kicked off at that point. So we're comparing a relatively normal open market that was at that time supposedly going through a Boris bounce to a full-on locked down, open and running, but under strict lockdown precautions market. And it's gone up by what did you say, 48%, did you say?
Yeah, year on year.
I mean, that's just incredible, isn't it?
Yeah.
It just shows you how much pressure I think the stamp duty holiday created, and desperation for people to actually get on and meet the deadline.
Yeah, and we're seeing that anecdotally. Before we sort of move on to the stories I've heard, and obviously people know I'm selling at the moment as well, but if that surge in February has surpassed the transaction levels in 2007, which was the biggest time of growth just before the financial crisis of the credit crunch back in 2008. So, I think all of that puts it into context, as you were saying, because that was my first thought. Like, we are 50% higher year on year than what would be classed as an inverted commas normal February, even though we're in lockdown. So I find it quite staggering, really.
So not only higher than last year, but higher than a previous peak year that was heading in to, or that was part of a boom, in fact, the tail end of a boom, just prior to a bust. So do you think this hyperactivity is part of a boom that we're going to see the end of soon and a subsequent bust?
Well, it'd be interesting, won't it? Because you and I have discussed this many times, both on the podcast and off the podcast. But once the deadline drops of June the 30th, and we know it then tapers down for a further 3 months, so I can't see everyone coming into the market just saying, okay, and then, the holiday stops, so let's just walk away. Because I think once you've started these cycles, or once you're in the the buying mindset or the moving mindset, I don't think that just changes. And maybe that's where the tapering will have an effect. But be interesting to see how long it continues. And I guess we'll only know the truth in that once there is no propping up of the purchase with the stamp duty relief.
Yeah, and we've got the stamp duty holiday fueling sort of deadlines for transactions to take place. We've also got really weird effects from the pandemic and lockdowns and furlough and people losing their jobs and other people having spare cash sitting around because of not commuting and things like that. So it's created all sorts of strange market situations around that. Some people have got more money and some people have got less money. And all of that's got to shake out yet. Assuming things settle down as this year goes on, and sort of settle down from a pandemic point of view, and those oddities in life also gradually settle down. I think that's sort of roughly, maybe, coincide with the stamp duty holiday coming to an end, and that will also coincide with the end of the year, which is traditionally a slowing time for the property market anyway. So I think we're probably going to carry on in sort of boom type market situations for the next few months, 6 months maybe. But then as we head into the end of this year, reality is going to be getting back to normal. People are going to be working out where they are. Some people who have been better off will probably go back to a bit more how they were. And the people who are really badly off from the pandemic are going to sort of work that out a bit more and be in a harder situation. Rental evictions and things like that are going to come through as well and hit people more with the debt that's been built up. I think all of that together is going to start at least slowing things significantly for the end of the year. And then I think the outlook for next year, for 2022, is a lot more questionable. I think it's too far out to make any real predictions. But yeah, I think this year's going to be a good year for the property market in terms of pricing and demand and transactions. And next year is probably not going to be as good, but we shall see close to the time. So do you think I'm talking nonsense, or do you reckon that sounds reasonable?
I certainly don't think it's nonsense. I think it sounds reasonable. We just don't know, do we? We experienced times that none of us have ever experienced before. I think for me, the question mark is over how we do actually come out of the pandemic and what that looks like, because as we know, it's not going anywhere, is it? It's going to be around now. So it's about, vaccinations and how that works and at what stage can we return to a semblance of normal living? Because I've got a friend in Australia and he's, they're talking about, air travel not really happening for several years. And so I think they're talking about it in real terms, although interestingly, I was reading an article yesterday about the fact that they're now calling it Aussiewood because so many A-list movie stars are flying to Australia because essentially it's just life as normal out there because they've essentially managed to fend off coronavirus. Yeah,
they've done really well at getting everything under control, haven't they?
Yeah.
And hence they're now living with very few restrictions. But still some on air travel. So that's interesting, especially for this area, which is very airport driven in its economy. So if air travel stays low for years to come, it's going to have an impact around here.
Yeah, and if that, again, there are so many different scenarios that you can think about. Even just talking about that, I'm thinking, well, if you can't travel as much as you used to, then it's going to still be very important where we live in terms of the physical environment, location. So that could help the market. So yeah, we don't know. But the other thing I was going to talk about was the anecdotal. So someone that I work with was talking about her her house. She's got a 3-bed house, and they're looking to sort of relocate within a short radius. But it was I think the last day of March, which was a Tuesday, they decided they would put their property on the market, and she put her property on the market on the Tuesday. By the Thursday, so just at the start of April, they had 18 viewings booked in. I haven't caught up with her yet, but 18 viewings in 2 days for a 3-bed property, and the property. Obviously, I don't want to give all of her information away, but let's just say it's around the stamp duty thresholds. It's in the ballpark. So that may have an impact, but I just think how phenomenal that is for a house of what I would still consider significant value, that there is that much interest. And we'll need to catch up with her about how many offers came out, but they're hoping to get more than asking price within 2 days.
Yeah, I mean, it just shows it's an anecdotal story, just confirming how much demand there is in the right area, at least.
Mm.
I saw recently, I think it was the Property Hub guys said that, in fact, I'm sure it was all over the place, but that's where I heard it from, that the Rightmove had over 9 million hits in a single day from people obviously looking for properties. I mean, it's Rightmove, so it's across rentals and purchases and things, but 9 million views or searches, hits to the website, so searches and then looking at individual properties. That's a lot of properties being looked at.
Yeah, and just on that, actually, there was something else I was reading that said Zoopla, after the budget was made, the week after, the number of visitors that went on to make inquiries, what they class as demand, had gone up by 25% just in that week. So if you imagine that's in the first week, and we think about that trending, that just...
Yeah. So it's all those people who thought, missed the stamp duty holiday window, now suddenly realise, it's been extended. Right, quick, let's go and get on with our property search. But I think it's very interesting that while there are lots of people searching for properties to buy, somehow there seem to be fewer people, or there seems to be an imbalance between that and the people putting properties up for sale, because there still seems to be much higher demand to buy than there is to sell. So presumably there's quite a lot of people trying to move out of rental into purchased property, because otherwise I don't quite understand how that imbalance could be. I suppose people perhaps moving out of living with parents, or if they're in a couple and they've broken up or something like that, perhaps there are other situations, I suppose, as well as just graduating from rental to purchase.
Mm.
I wonder how long this level of demand can sort of continue. Are we going to reach a peak number, or reach a limit on the number of people who are in this situation and are able to purchase the property and interested to purchase property, especially as prices go up? I assume that's going to reduce the number of people who can purchase. Or is there effectively an infinite supply of people waiting to come through and discover that they want to buy a property? If there is, well, I'm assuming there is not an infinite supply, so there must be a limit to the number of people. So when are we going to hit that limit? How many more weeks and months of increasing demand can we see in the property market before it starts dropping off?
Yeah. I just thinking about what the government's done, because I mean, as we're talking about this, I'm obviously thinking about what this means for us as investors, us as developers, and I think there is always going to be need for rented properties, whilst people have to save what's required or work through what's required. Because the other stat that I was reading about recently was just about the fact that a lot of buyers now have more equity, which means they're coming from obviously existing houses. So there is a bit of a gap there where people aren't going to be able to afford, because obviously if you're not in a property and don't have equity, you're not going to be as close to the front of the queue with lenders as someone that's got a significant amount of capital cash to put down. So someone that can get a 60% loan to value is going to be far more attractive to a bank than someone like me at the moment that might want 85% or 90%, because obviously the risk's much higher with someone like me than it would be if someone's going to put 40% down as a deposit. I
think with prices increasing, as they seem to be at the moment, so actually, I mean, I suppose lots of people are saying that the property market at the moment is very, very local. And there are lots of areas that are seeing prices and demand and prices drop. So, for example, non-prime central London. So the sort of high-end central London, I believe, is still seeing reasonable demand and prices holding. But sort of your more standard, if you like, living accommodation in central London is dropping in price and the demand doesn't seem to be there. And yet, outer London and home counties and southeast and stuff, huge demand, prices are definitely going up. And I'm seeing properties come onto the market around here that are perhaps coming on at £100,000 more than I might have expected a year or year and a half ago. And that's, I think some of those ones at that sort of range are probably a little unrealistic, but it's still a big difference, both in terms of obviously the percentage rises, which I've seen some people quoting sort of 20% or more increase in a year, which is just crazy on its own, but also in terms of the actual cash increases, which are also crazy amounts. And this has got to stop people being able to afford them before long. Yes, if you're coming from an existing property and you've got equity, you can extract that equity and then roll it in as a deposit, which you can then leverage further against. But there's still a limit, and lots of people are not in that situation of having lots of equity to put forwards for first-time buyers, or they're in a lower-end property that has not increased in value as much as sort of some of the higher-end ones. So it's, yeah, there's got to be a limit to this. There's got to be an end to it at some point. But I'm not sure how close to it we are. And if it's still some way off, is this an ideal flipping market? Should you be going out and buying a property now as quickly as you can with the intention of selling it again in 6 months? Do you think that's sensible?
Well, you're talking to a man that wanted to buy a property and sell it in 6 months, and I bought that property in October 2019, and we still got that property. So my view on that is probably a more cautious one than it might have been in the past. I still have the same view, which is, as a property investor, unless there's some real indicators in the market, or the local market so well that you just think this isn't the right time. That, everything's individual. But for me, if I'm looking to do a project, provided the numbers work, and if I've done I hesitate to say due diligence because in the property world we hear it so much now, but if we've done the right work and we think that our forecast value is the right one, then I think the time to do it is always now. I think if waiting is you and I have talked about trying to time the market, and I just think it's a fool's game. And this is, this could digress us into the other conversation, which is I always hear people talking about which areas are best, and I think that's fine if you are going to do the 6 month flip. A 6 month, it could be a Freudian slip. But there are so many other factors involved, as I've experienced personally, that if you're happy with the development, as in the purchase price, and you think that your forecast price is right, based on current evidence, then you should go for it. Unless we think there is going to be a crash in mid-year, but we've just talked about that. The stamp duty threshold runs until September. Depending what part of the country you're in, if you're in the north part of the country, up to 250k, you're still good anyway. So, for me personally, and I am probably more of a glass half full person in this anyway, but I think the longer you wait, the market changes. So, as we've said before, if you wait because you think, the market's going to dip a little bit, fine, it will, but so will the end value. So, it's one of those. I think you have to look at each case on its own merits. Unless you think there is going to be a cataclysmic event in the Chicken Little mould. Yeah, the sort of flip of that, to use the same word in another sense, is that I'm looking to purchase at the moment for long-term rental, but I'm seeing prices going up, and I'm thinking in the longer term that they might come down a bit again, maybe in another year. So should I wait? Should I
not buy now, but perhaps hold off and buy in 12 months, 18 months time. And as you said, I think because in this area, rental demand is going up along with purchase demand. So it can be difficult to find good deals. It can be difficult to get in fast enough to find a property to actually buy. That the numbers still work. So yes, the purchase price has gone up. Yes, I'll have to put in more deposit, and that may mean that I can only buy one property at the moment rather than the two that I might have liked to do at this sort of time. But they still work from an ROI point of view because the rents have also gone up. So yeah, I'm still thinking, despite my slight concerns about the mid to longer term prospects, I'm still thinking that, as you say, if the numbers work, today's the day.
And you're thinking in terms of like 10 years. So if you buy this property, the likelihood is you're going to have it for about 10 years.
Yep. However, during those 10 years, I will probably have to remortgage it. And if I mistime that remortgage and it's gone down in value, it can still create problems. Which is then, of course, another sort of big question when you're buying a property now. How long do you fix for? Is fixing for 2 years and getting a lower rate best, even though perhaps that might land you in the middle of a slight dip in prices, and then might find that your loan to value is degraded? Or should you fix for 5 years, pay slightly more on the interest rate, but hopefully maybe ride out that dip if it happens at all? Lots of decisions.
There are lots of decisions. I think, there's pros and cons to each, but originally we were talking about flips, and I come to the same conclusion, which is if the numbers look right, do it. If you're talking about longer term buy-to-lets, if the numbers look right, do it. I think the 2-year, 5-year fix is a good thing to call out for anyone thinking about it, because it can cause a problem when remortgaging. The likelihood is that in a 2-year time, if you've consistently paid the mortgage, the property values, have they dropped more than 5% in a period like average? They haven't, I don't think.
But then look at the last year, 10 to 20% price increases or property value increases in a year. That's pretty much unheard of as well. Number of transactions up 50-odd%, also unheard of. So perhaps the other side of this big upwards trend is also a sharp downwards trend.
Yeah, I think with loan to value, my point is though, so typically for buy to let, I'm usually looking at 80 or 85%, but for a standard buy to let, you might be looking at 75%. But I think even on those sorts of values, the likelihood is for most investors, you're going to be adding some value to the property in terms of aesthetics, but also the value is that it's rented, it's been rentable, and assuming you've got that. I haven't experienced, I've got 2 mortgages actually where we have just finished on the fixed terms. In fact, it's the further borrowing that's finished on the fixed terms, where now the borrowing is greater than the original valuation. So there's 2 properties, let's just say, so both were mortgaged at 85%, but based on the bank's current valuation, they haven't done an actual valuation, but based on their desktop valuation, they're saying, well, actually, the borrowing you've currently got comes in at 86%, and therefore we don't have a product for you. So that is just highlighting what the point that you've just mentioned. Now, it just so happens that this is on the further borrowing.
So looking at that particular case, these are presumably properties in your sort of main investment area in the southwest. So I'd be interested to know, just anecdotally, what's the market actually doing down there? I've mentioned a bit about Red Hill already, around where I am, looking to invest, and how things seem to be going up and up around here. But yeah, what's it doing down there?
The southwest hasn't changed much, to be honest. Well, I say that it's a big area, so some of the areas are increasing. So I think Devon's increased, Cornwall. It's funny, I was looking at this recently in terms of the areas. The area I'm in has always been fairly static. So it has varied, but the anecdotal evidence has been a lot of people moving out, so down into the southwest. But the area I've moved into, in terms of investing, has always remained fairly static, and I've kind of accepted that because my primary driver was around cash flow. Obviously, I am looking at capital growth, but it was primarily around cash flow. But I think over, I forget the actual figures, but every sort of year or so, we were looking at sort of like 5%, just very incremental growth. The difference for me is obviously that I tend to add a significant amount of value into the properties that we're going into, most of them. So,
yeah, your value increase comes from the work you put in rather than from the natural movement of the market.
Yeah. So I haven't yet approached the further borrowing challenges because at the moment the difference to me isn't huge. But I think it's a really important point that you've mentioned out, because if you did that and that was on your main borrowing, and your main borrowing had exceeded what the loan to value was on the original valuation. I know this gets a bit technical when you're talking about it, but if you'd borrowed at 85%, but based on a bank's devaluation of your property, it now improved to 90%. That means, they're called like zombie mortgages, right? Because you can't do anything with them.
Exactly. You're stuck on the standard variable rates.
You're stuck on a standard variable rate, which I have, through my own poor administration, been on once or twice for a month or so. And I can tell you, it makes a huge difference. A huge difference.
Yeah, I mean, typically you might be looking at interest rates changing from, 3% maybe, up to 5%, maybe even more.
Try 6 for mine. And it was, and I know it sounds really simplistic to say, but, and you and I have talked about this before, but it made such a big difference from, if you imagine that 3%, that's,
it's doubling the mortgage effectively, isn't it?
Yeah. And it did, because I remember just looking at my statement and just, literally tears coming out of my eyes. My eyes were watering. And I was like, oh my God, so next call was straight to the bank. So we do have to be mindful of that. I think bringing this back around to our conversation, my view is I tend to go for the 2 years, but that's because of my strategy. But that's because typically I'm adding on suites. In the house I've just done, we've actually repainted the front of the house. We've put new doors in. So we're attacking it from all sides. Curb appeals increased as well as the internals. So I have greater confidence that in 2 years' time, even aside from what I've just said, I have greater confidence that we'll be there or thereabouts. And the reason I have that confidence is because my strategy is based around multi-living, about co-living. So the valuations are sometimes slightly different, not always bricks and mortar, because they are looking at revenue. They're looking at the rentals in the property. But I think it's a really good shout that, what you've raised for people to be aware of, particularly now.
Yes, indeed. It's on your HMO front. Yeah, I think it's where you can get a commercial valuation based more solely on rent, that obviously sort of helps alleviate some of that risk from fluctuating property values. But yeah, and when you're looking at residential mortgages or residential buy-to-let mortgages, the value of the property is still a very big element of it.
Mm.
I think there are risks there, and you do need to be aware of them.
Yeah, I know we're out of time, but and it's probably another conversation we'll have another day. But I'm starting to get quite passionate about, particularly when we look in the property circles, is that we all get hung up on recycling our money. Well, I say we all, most of us, because it's such a great prospect, isn't it, that we can take some of our money, invest in an asset that then gives us all of our money back and possibly a little bit more, and is generating revenue for us. Who wouldn't want that? I would assume most of us want that. And we can get hung up on that. And I certainly can, and I have. And I'm sort of now getting a bit passionate about helping people to understand that, if the numbers work now, yes, it would be great. But if you could get it at 75% loan to value, or even 80% loan to value, your tolerances are just a little bit higher and just gives you maybe a little bit more scope if, God forbid, if things don't quite pan out in a couple of years' time. At least you've got a bit of a buffer where in 2 years' time you might not have to start digging into your own pockets, or the property itself isn't generating any income. And actually, we did have this on my very first investment property, which was my wife's. We were actually putting money into that property. So we owned the property. We had a buy-to-let on the property. We had someone in the property paying rent, yet we still put £100 into that mortgage every month.
That's not an investment.
Not for us. It certainly wasn't for us. I think it was for the bank.
yeah, great.
But I would say, just to defend myself before anyone thinks, blimey, this guy must be an absolute idiot. We did that because at the time, this was, funnily enough, around the time of the financial crisis, around 2007, 2008. And I personally just didn't feel it was the right time to sell it, because that was, my wife will disagree with me. This is a constant battle we have, but she wanted to sell it. And I said, look, let's just hold on to it. Yes, we're going to have to put money into it, but I think we should just try and, just get through this sort of choppy waters of and thankfully for me and my marriage, it proved to be a good decision.
Was that a repayment mortgage you were on at that time?
No, it wasn't. No, it was interest only.
Really? Interest only? And you still had to put in more than the rent that was achievable? Wow.
Yeah. It was painful. It was painful. Every month I winced when I had to put my hand in my pocket and top up to pay a mortgage. But that did only last several months, probably about several months before the market started stabilising itself and the banks were willing to come back to the table and say, yeah, bit like it's been several months ago, mid 2020, when the banks just didn't know and they were downvaluing everything.
Yeah, that's an interesting point. I remember talking about all the down valuations that were happening. And yeah, now look at the market. Wow.
Yeah, well, I know we're well over, but we did talk about that. So the property that I just developed, I think we must have talked about this, but yeah, the property that I just developed, which was valued about 3 years ago at around 240. And since then, and we'd done some work on it then, it was valued at 240. I bought it for just under 200. Since then, I spent a crap load of money on it, 5 en suites. Really nice design-led property. And I'd actually had I paid someone independently to come in and value it because I was just keen to know. So I thought I'd invest the 500 quid. And he put it in my ballpark. Let's just say it was around the 300 mark. Anyway, the bank's valuer came round, actually called me a couple of times, very nice chap. Went round to value it. He valued it. And when it came back via the bank, he valued it at 240. So even though I'd owned it for a few years, and this was from the same bank. That bank had already valued it at 240. I've just spent in excess of, let's say, £50,000 on it, and he decided that it was still worth exactly the same as it was 2 years ago. And that was...
Was this last year?
This was back end of last year, so we're talking, October, November time. And that's the point, the same as sort of 2007. So he wasn't willing...
Yeah, everyone was still feeling a bit shaky around that time, weren't they?
Yeah. So I then had to get it to go with another bank. And I don't know if I've told this story. Maybe we can tell this on the next podcast. But basically, I went to I don't think I have said this on the podcast. So I had to go to Land Bay instead of Kent Reliance. And went with Land Bay. They sent the valuer out. The valuer called me up. It's the guy that I'd paid independently to go out and do it for me. Who I just so happen to have a really good relationship with. And that has no bearing on it because he's a professional that's been in the industry for 40 years plus. So, but it was just a moment where I was like, oh, thank God, because I knew that he would, worst case scenario, value it at the bottom end of the high valuation, if that makes sense.
Yeah, great. That works better.
Yeah. All's well that ends well.
Indeed. Speaking of which, we're overrun. we must bring this podcast to an end. So thank you very much for listening. I hope you've enjoyed being a fly on the wall to our property chatter, talking about some of the recent property news. And if you have enjoyed it, please let someone else know about it. And most importantly for us at the moment, it would be fantastic if you could leave us a rating or review in whatever podcast listening system you use. If you'd like to find show notes and links to things we've mentioned, Those can be found at thebusinessofproperty.com. And Stuart and I will talk to you again next week.